$500 a month sounds almost too small to matter, and that's exactly the trap, because here's a fact that sounds made up, but isn't. Ordinary people investing modest amounts have quietly become millionaires without anyone around them ever knowing. One Vermont janitor and gas station attendant did exactly that, building an $8 million portfolio simply by investing steadily and living below his means. Nobody found out until after he died. That is not a lucky exception. That is what happens when you understand one simple mechanism most people never truly grasp, so stick with me, because by the end of this video you'll see $500 a month in a completely different light. Here's what most people get wrong about building wealth. They think it requires a huge income, a lucky break, or some secret strategy only rich people know about. But that's actually backwards. Even Warren Buffett, one of the richest people alive, built almost all of his fortune extremely late. Roughly 99% of his current net worth was generated after he turned 50, not because he suddenly got smarter in his 50s, but because compounding simply needed decades to do its work. So the real question isn't how much money you start with, it's whether you understand the mechanism working quietly in the background the whole time, and once you see it clearly, $500 a month stops looking small and starts looking like a very different kind of tool. Let's start with something simple. There's an old trick called the rule of 72. Divide 72 by your expected yearly return, and you get roughly how many years it takes your money to double. At 8%, your money doubles about every 9 years. At 12%, roughly every 6 years. That gap sounds tiny on paper, but stretched across 30 years, identical monthly contributions at those two different rates can end up around $400,000 apart, same money in, wildly different money out, purely because of the rate it grew at. But here's where it gets genuinely interesting. Compounding doesn't grow in a straight line, it grows in a curve that looks almost flat for a long time, and then bends sharply upward later. Most people quit investing right before that curve gets interesting, because the first years feel like nothing is happening, when in reality the engine is just quietly warming up underneath. There's a real example that shows this perfectly. Someone investing just $100 a month starting at 25, at a realistic 7% return, ends up around $262,000 by 65, even though their own total contributions only added up to $48,000. The rest, more than $200,000, was simply created by time and consistency, not by some clever trading skill. Now here's something that quietly explains why so many people never get there. Even though the math is this obvious, it comes down to a well-documented bias in how our brains handle time. We naturally undervalue rewards that sit far in the future compared to rewards we can grab right now. So $500 spent today always feels more real than $500 compounding for a future version of yourself you can't quite picture yet. There's also a second, quieter reason. Researchers have found that people feel the pain of losing money roughly twice as intensely as the pleasure of gaining the same amount, so market dips feel emotionally enormous, even when, historically, they're a normal and temporary part of the process. This single bias alone causes many people to sell at exactly the wrong moment, or avoid investing altogether out of fear of a dip that hasn't even happened yet. And there's a third mental trap worth knowing. Economists call it mental accounting. It's the tendency to treat money differently depending on which mental bucket it sits in. That's why someone might swipe a credit card without thinking twice, but hesitate hard before moving that same amount into an investing account. The money isn't actually different, only the label in our head is. This is exactly why the smartest move isn't relying on willpower at all. It's removing the decision completely, setting up an automatic transfer the moment income arrives. So the $500 moves before it ever has the chance to feel spendable. This single shift is one of the most consistently effective behavior changes researchers have found in personal finance, not because it's clever, but because it makes the good decision automatic instead of optional. Let me make this real with a few examples. Remember that janitor from the beginning. He wasn't chasing trends or trying to get rich quickly. He quietly bought shares in familiar, boring companies over decades, and let compounding do what it always does when given enough time. Nothing about his income was special. What was special was simply that he never stopped and never touched it. Second example, and this one might surprise you, the entire idea of a simple index fund, something now considered one of the safest ways for an ordinary person to invest, was originally mocked when it launched in the 1970s. Critics at the time called it practically an American, arguing it would guarantee only average, mediocre returns forever. Decades later, that same mocked idea has quietly become one of the most reliable wealth-building tools available to ordinary people with completely ordinary incomes. Third example, something that's changed very recently and barely gets talked about. Until fairly recently, if a single share of a company cost several $1,000s, someone with $500 simply couldn't own a piece of it. Now, thanks to fractional investing, that same person can own a small slice of that same expensive company for just a few dollars, meaning the tool available to a completely average investor today is genuinely more powerful than what most wealthy investors even had access to a generation ago. So let's bring this together. Building real wealth on $500 a month was never really about the amount itself. It was about understanding that the money undervalues the future, fears temporary losses more than it values steady growth, and gets mentally boxed into buckets, even though it's all exactly the same. Here's the good news though. Once you see the mechanism clearly, the fix is almost boring in its simplicity. Automate the transfer, choose a broad, boring, diversified investment, and then do the hardest part of all, nothing. Let the years quietly do what they've always done for people who stayed in long enough to let the curve bend upward. Because real wealth building was never a sprint of clever decisions, it's closer to a quiet, patient rebellion against every instinct telling you to spend now, sell during fear, and underestimate a future that feels too far away to be real. So tell me in the comments, what's the one thing that stopped you from starting your own $500 plan? I actually read these, and I'd love to know I'm not the only one who's had to fight that instinct. If this video changed how you see a simple monthly amount, hit subscribe, because I'm breaking down the real psychology behind building wealth every single week, and I'll see you in the next one. Disclaimer. The content provided on this channel is for informational, educational, and entertainment purposes only and does not constitute financial, investment, legal, or tax advice. All opinions, analyses, and statements expressed are based on personal experience, personal research, and publicly available information and are subject to change without notice. No guarantee is made regarding the accuracy, completeness, or reliability of any information presented. Investing in stocks, cryptocurrencies, ETFs, or any other financial instruments involves substantial risk and may result in the partial or complete loss of capital. Past performance does not guarantee future results. Nothing on this channel should be interpreted as a recommendation, solicitation, or endorsement to buy or sell any securities or financial products. All investment decisions are made solely at your own risk and responsibility. Viewers should conduct their own independent research and consult with a licensed financial advisor, tax professional, or legal advisor before making any financial decisions. The creator of this channel assumes no liability for any financial losses, damages, or other consequences arising directly or indirectly from the use of the information provided in this content.